It's very, very, it can be a very painful process.
Yeah. But increasingly people are talking about relocating various more tax-friendly places, shall we say, around the world.
You can have a better opportunity going to potentially a different country like Dubai. And a lot of people feel like they're paying quite a significant amount of tax and they're probably not getting the services that they think that they should be receiving.
Hang on a minute, I was okay paying what was effectively 20% at the time,
Yeah.
and now they want to potentially pay 45%. It wasn't even on the agenda to think about relocating to another country, and they think, well, hang on a minute, I could actually pay zero.
But the thing that I always highlight is, I know you've been there for a couple of weeks, but think about this, if you're going, you're going to have to stay out for at least 5 years.
Hi Malli, welcome to the podcast.
Great to be here, Alan.
It's good to see you. Look, we're going to have a hopefully a really interesting conversation around tax, and particularly as it relates to business owners. But before we get into that, I'd love to for you to share with the audience a bit about your backstory, because it's pretty unusual, I have to say.
I completely agree with that. It's slightly unorthodox, I think. So prior to me, entering into the tax field, I actually qualified as a doctor. So I went through my medical degree and actually worked in the NHS for 4 years as an orthopedic surgeon. So I did pivot. It's not the usual pivot as people go for, but that's what I decided, because I think at that stage there was a decision I needed to make as to whether I wanted to pursue this career in medicine. But I had sort of outside interests. I really enjoyed entrepreneurialism. I also liked finance. So it was the perfect time. I wasn't married at that time, no children. It was the perfect time to think about pivoting. It's happening more and more, unfortunately, but people are using that degree and going to different careers. But maybe not tax. Tax is probably a little bit of an unusual one.
It just struck me when I sort of saw on your profile, you've done that, the medical route, and it's a complete kind of although I imagine there are some transferable skills.
Oh, yeah, 100%. I mean, look, I think medicine's amazing. I've learned so much from it, especially a lot of the soft skills and bedside manner, being able to explain complicated things in a simple, plain English like manner. That's kind of what I've taken away from that. And obviously people find it interesting to hear about that. And I think that'd be a whole different podcast as to why people are switching from
career
medicine.
changes. Yeah, that's an interesting one. So I mean, what is your role now? What is your title, and what do you do right now?
Okay, yeah. So I'm a tax partner at a firm called Blick Rothenberg. So we are an accounting practice, essentially a top 10 firm, and we look after owner-managed businesses and the owners of those businesses. So I've been at Blick Rothenberg now for over a year, and prior to coming to Blick Rothenberg, I've worked in what you call the Big Four. So I've worked at PWC and EY prior to that, and working all the time with owner managers and their businesses, essentially. And so what I do now at Blick Rothenberg is I sort of lead the sort of entrepreneurs practice. So looking after business owners and helping them scale through to hopefully an exit. And if they want to go again, we're here to do that with them as well.
Excellent. So tell me, give me a sense of the sort of, I mean, there probably isn't such a thing as a typical client, but if there was, broadly speaking, sort of what sort of size or position are they on their entrepreneurial journey when they come to speak with you?
Typically, where we add value is where there's a little bit of complexity. Okay,
Right.
So the size of business would essentially be sort of a 5 to 10 million of revenue on the from their starting point, and they've probably received some sort of funding, like a Series A type funding.
Right. Okay.
And that's where things get more interesting for them. Things start getting a bit more complicated, and therefore they need an advisor that can help them scale.
Right. And across lots of different sectors?
Yeah, we're sector agnostic, but obviously with current climates, it's tech.
Yeah.
Tech has got to be the thing. So AI is becoming a very, very, it's a very focal area right now.
Interesting. So look, let's just dive straight into this. I just want to imagine a situation of an entrepreneur, a founder that's been growing a business, and they're at that sort of level. They've been working with you for a while, but for whatever reason, they've come to the conclusion that maybe in the next 2-3 years, that sort of time scale, not next week or next year, and not 10 years away, but relatively sort of short to medium term. They're thinking, yeah, I'm going to plan an exit. I've had a couple of offers, not quite ready yet. I'm really interested in the steps that people ought to begin to think about, effectively to be tax efficient, to make sure this is a kind of a clean exit and everything is maximized to the best of their ability. What sort of areas should people be thinking about?
Alan, really, really good question, and it's a question that always gets asked. I think if a client is in that position, firstly, amazing that you've got offers that are coming through, and secondly, the fact that they're even thinking about it, right? Thinking about preparation, because a lot, as you can appreciate, entrepreneurs such as yourself, you're constantly just working on the day job to try and maximize value within the business. I think the areas that I kind of layer it. So you've got to think about it, and this is an analogy that's always used within the industry. It's like you're going to be selling your house,
Right?
yeah. So you've got to try and make sure that everything is sort of looked at. So when a future buyer comes in the future, in the future to try and acquire that business, that everything is in order. So I kind of layer it from looking at it from a company perspective. So are the finances in order? Are there any sort of skeletons in the closet that you need to try and remedy before a future buyer comes and looks at it? Or if you need to have it all out there for them to know as part of a future sales process. So that's the sort of the company level. Then you've got the management level or shareholder level, just to make sure that you maximized, your reliefs, so business asset disposal relief, or what it used to be called entrepreneurs relief, other ways of trying to maximize that between family members, for example. Are you incentivizing employees who are going to help you get through that journey to that sales stage? So option schemes, EMI options, are those in place correctly? It's those sort of things. Now you've got that North Star and you've got it in your mind, you're going to be selling something in 3 years' time. How are you going to get there? And then lastly, the one that drops off quite in most instances is as a founder, your personal shareholding. How are you going to hold that, right? If it's a first time sale, typically you will probably just retain it in your own personal hands. But if there is an opportunity for you to maybe wrap that up in another vehicle, so you might hold that in a personal company, then that might be helpful, because you could potentially reduce your tax liability.
And doing that like way ahead of time, just kind of a bit of sort of shareholding restructure in advance.
Absolutely right. So it's not something that you would do 3 months out. Right.
Sure,
you need a good 12 months to 2 years, I would say. Look at holistically across the piece to make sure that you're sitting within the reliefs that you need. And in some of the things you might need to go to HMRC for clearances, which is fine. Sure. We do that all the time, and it's just to get comfort. But it's not something that happens overnight. I think unfortunately sometimes we see people come to us and they're like, oh yeah, I'm now ready. We're going to be selling in 3 months. What can we
fix
do?
Everything for me now.
What can we do? And so our offering at that point slightly pivots. Then it's kind of like, okay, we'll support you through this, but we can't be as proactive anymore. To try and like make things as efficient
that's the
as
key
possible.
message. Just give yourself plenty of time. These things do take time, inevitably. I'd imagine, particularly getting approval from HMRC and whatever, it's not going to happen immediately.
I mean, for some of the ones that are statutory, or what we call have to happen through there's legislative processes for that, then that takes about 30 days. But sometimes we can get it through quicker if they have time.
You've got your contacts.
I don't think it works like that. I wish. I wish.
I really like the analogy, and that makes perfect sense to me. If you were thinking about selling your house, you wouldn't just put it on the market as it is. You give it a coat of paint, you tidy it up, you make sure everything is looking as beautiful and presentable as it could be to potential buyers. So it's the same sort of thing.
It's the same principle. The only thing is, if you're selling a house, you could probably do that in a couple of months.
Yeah, right.
Whereas for this, you need 2 to 3 years. But the other thing I would say is about getting your house in order. Okay, just sticking with the analogy. The other thing is, make sure you have the right advisors around you.
Right.
So what does that mean? So I'd say in order of priority is make sure your financial team, so either internally within your business is up to scratch, having your accountant and tax advisor set up. It might be the same person. Lawyers who are going to implement this for you, or can translate whatever restructuring that needs to happen into what I call legalese. And obviously, if you've got if someone's going to sell that business for you, who's that going to be? Like some people might think, well, actually, I know this industry really well. Whatever industry it might be, I know all the people that are likely to want to buy my business, so I'm going to do it myself, which can work sometimes. But I'd say speak to some corporate finance people who are used to selling businesses in your sector, who can then also actually assist with how can you increase the multiples? What do you need to do? And if you're 2-3 years out, you've got time to think about, okay, if I want to maximize my multiples, what do I need to do?
Sure. I think that's a key message as well, is begin to build that team. Maybe people you're already working with, maybe other people you want to bring in. but do it relatively early, like corporate finance teams, for example. There'll be people that you get on better with than others. There'll be people who've maybe got a deep expertise or specialism. So rather than, wait until it's, oh, no, I've got to find somebody quickly, begin to, I guess, build relationships with a number of different sort of professional people. And
100%, because they are going to be your core team.
Yeah.
And unless you've sold a business before, you're going to underestimate just how much of a drain it's going to be, right? And the amount of times I've heard when buyers come to say buy my client's business, and they'll say, actually, it'll be very light touch. It's not going to be, it'll be done in a couple of months.
They all say that, don't they?
Yeah.
A lot of them, yeah.
And then lo and behold, it's very, very, it can be a very painful process.
Yeah.
Because they really, look under the carpets, look under the sofas, everything.
Yeah, as you would if you were spending a lot of money buying
absolutely,
buying a business.
Absolutely.
So get prepared. Give yourself plenty of time. Is a key message there.
100%.
You said something interesting. I wouldn't mind just taking a slightly deeper dive on that. This idea of shareholdings, a bit of sort of restructuring ahead of an exit, and things like family members. I mean, you think specifically about if there's a spouse or children that aren't currently shareholders, you would consider allocating them some equity in a business. Is that what you kind of part of a kind of
it needs to. I mean, ideally, it should work commercially as well. But
yes.
You let's sort of simplify this. So in terms of business asset disposal relief, okay, so or what used to be called entrepreneurs relief, that's currently sitting at 14% for capital gains tax on a lifetime allowance of £1 million. Okay, the current capital gains tax rate is 24%. So you're looking at a 10% benefit right now.
Yeah.
That's going to get tapered down to 18 actually. So you still got a benefit of £100,000. So you could multiply that out across, family members potentially, but you need to structure that early because
so
you need
other family members will have their own allowance. So you
can exactly 100%. So you could have potentially have your wife as a shareholder, and that multiplies out the lifetime allowances. But for that. To qualify for that, you need to at least have those shareholdings for at least a 2-year period and meet other conditions. So hence goes back to your point, which is okay. How long, should you be thinking about this? Yeah. That's where you start looking at all the different relief levels. Some of them are 12 months, some of them are 2 years, et cetera, et cetera. So you're looking at a 2 to 3 year period.
Yeah. Just get the conversation started. And it's not necessarily always as easy as just doing that. Just I'll bring my family members.
No,
there's loads of other considerations there.
And you got to consider any sort of there's lots of anti-avoidance rules and things like that. So as you've been saying, get advice early.
Yeah.
Yeah.
That's what we keep coming back to.
Yeah.
Now, slight pivot here. Look, we know in the last budget there were quite a few changes actually when you begin. It was kind of the most interesting, shall we say, budget for a few years. So obviously, with the new
kept us very busy.
Yeah, a new administration coming in.
Yeah.
One thing that certainly caught my eye is around inheritance tax for business owners and shares in private companies. Looking back on it, I mean, there was a lot of noise was made and still is being made around the farmers with agricultural relief. A bit less so with business owners, but just sort of unpack that a little bit. What's the position now, and what is it going to be going forward from an inheritance tax viewpoint in terms of the value you've got in a privately held company?
Yeah, so just to give a bit of context to this, so prior to the changes in the budget, broadly speaking, if you were a founder and you owned a business, those shares would qualify for inheritance tax relief, so business relief. So pretty much all of that shareholding would be outside of would be relieved from your IHT estate.
So that could pass on to family members or whoever.
Yeah,
outside of
essentially tax free. I mean,
tax free.
This is transfers to your spouse. Yeah. It would always be exempt anyway. But when we're talking about family businesses who might be trying to pass on value to their children, that's when it was key. So one of the topics that we always talk about with clients is succession, and in the back of their mind, it's something that's important for obviously most founders, but they're from an IHT perspective, they just thought, well, this is all, it's going to be zero. So I'm not really too worried about that. But from the October budget, what they're doing is they're introducing a cap to the value that would be subject to 100% relief. And that cap is now £1 million, which sounds like a lot, but as you can appreciate, for a lot of businesses in the Southeast, there's lots of businesses that are way beyond that level of value. And so we're having a lot of conversations right now with large family businesses who are thinking about succession, which was always on their top 5 list, but now it's really reached the top of their list to talk through that. So coming back to what can people do, I think the first thing is essentially look at what the picture looks like for the valuation of your business and what is your inheritance tax exposure. Do you still want to pass that value on to the children, or do you want to do something else? And what is that something else? That something else is, do you want to just sell? Right. So this is a decision that a lot of families up and down the country are making as to whether they want to still pursue succession or they want to think about exiting.
And you were seeing that in some of the conversations you're having.
Yeah.
They're actually rethinking. They were planning to pass on to the next generation or children. Saying,
yeah, I wouldn't say it's. I mean, the rules don't come in till April 2026, so people still have time.
Yeah.
But it's definitely now it's on the table to think about with the amount of tax that we might have to pay. How are we going to find those funds?
Well, that's the thing, isn't it? Because if in the event of that happening, I think that's one of the key challenges. There's not a lot of liquidity. The business, the founder or whatever has passed away.
Yeah,
there's a tax liability then created, but the money's not necessarily, because the money is still in the
Correct.
business. The asset itself is not a liquid asset. Versus if they died with £1 million or £10 million in the bank, they use those funds to meet the tax liability.
Exactly.
So that's
so it's correct,
Yeah.
and it's accelerating those conversations between generation 1 and generation 2 as to what they want to do and do they really want to continue this business or not. It's also accelerating lifetime gifts. So you can gift those shares to your children during your lifetime. There is potential like capital gains tax issue with that, but there could be potential reliefs. So there's a lot of planning that needs to be considered at this stage. And also not to ignore that actually this is what we call a second death problem. So in terms of if your wife, if you're married, etc., or have a
or husband,
exactly, or civil partner,
that
you could pass that on to them on death.
Outside of all this stuff,
exactly. So it's more on
it's the next generation. The second death. I mean, I guess simple things that if you really want to find the funds to meet the tax liability, you can, if health allowing, you can insure yourself.
Correct. But for some of these businesses, it's very, very, it can get quite expensive.
Right. Because I mean, they're worth a lot of money. Therefore, the tax liability is going to be run into the many millions.
Correct.
So it's like insure yourself for 10 million quid.
But it's that conversation. So it's starting from the basics. So have you got your wills done correctly? And for example, are all your shares going to go to your other half? So then it's not an issue on your death, but you still got that second death issue. Can we do some restructuring to improve the position? Can we do some like lifetime gifts to children, to try and reduce that exposure? Insurance,
sure.
And then are there some nuclear options that you want to think about doing, which is basically convert it all to cash? I mean, that doesn't improve the inheritance tax problem, but at least you can then gift cash and think about
arguably it's worse then, isn't it? If you've got cash and then you've got 40% liability on everything at that point, but you've now got liquidity, so you can begin to do some
you can begin to do some
planning,
have some more flexibility, or and what some families have been doing has been around with the new rules. You have an inheritance tax exposure depending on how long you've been here in the UK. So you can lose that inheritance tax exposure if you're out of the country for 10 years.
Right.
So people are looking at that as an option as well.
Funny you should say that. Because
are you thinking about doing that?
Not yet. But that's where I wanted to go next. And I think this is a really interesting subject. Look, there has been so much in the press and media. I've seen it myself in our business. I'm interested in your experiences. People literally relocating, whether it's inheritance tax or just generally tax and or the kind of the business environment. There seems to be, not with everyone, but a generally kind of a sort of negative sense of kind of the business environment, the commercial environment is going through a challenging period. The country in general, we have all around the world. We're not unique in this, but increasingly people are talking about relocating various, more tax friendly places, shall we say, around the world. Really interested in your experience. Have you had clients discuss this with you? Have clients relocate?
It's probably one of the top topics that we're having and we've had sort of trailing up to the budget and post budget. It's probably calmed down a little bit post budget, but especially coming up to the budget, because as you've rightly said, Alan, it's the sort of business sentiment has been quite negative, and the noises that are coming out of government right now has been very negative, especially towards wealthy individuals and business owners. I'm not here to talk about whether it's right or wrong. Yeah. It's just more that's what the business community is feeling, and a lot of people feel like they're paying quite a significant amount of tax, and they're probably not getting the services that they think that they should be receiving. So we are having a lot of conversations, and we've had several clients who have moved out of the UK to other territories. The one thing I would say is, obviously, if you look at it in a pure tax lens, you can have a better opportunity going to potentially a different country like Dubai. So Dubai is quite popular with a lot of young first-time entrepreneurs, or because the ecosystem is good there. There's zero tax from a personal tax perspective, 9% tax for corporation tax. Yeah. But the thing that I always highlight is, I know you've been there for a couple of weeks, but think about this. If you're going, you're going to have to stay out for at least 5 years.
All right, this is what I really wanted to get into, kind of the rules and regulations. You can't just go there for 6 months or something. And well, you I guess you can, but it's not going to particularly help you from a tax.
No,
tax
so
standpoint.
we, rightfully so, we have a sort of an anti-avoidance rule where if you're non-resident temporarily, once you come back, you get, you have a tax pickup. Right. So the typical scenario that we're seeing with some entrepreneurs is they're coming up to a liquidity event, they're exiting for a significant sum, they're looking not to be here when that happens. And the way that the tax rules work right now is if you exit a business whilst you're non-resident, then it's not taxable from a UK standpoint. Okay, so so if it's a significant sum, people are looking to say, well, actually, I'm not liking the environment here in the UK right now. I can potentially shift my family for at least I'm okay to take the 5-year period. I'll do that, and hopefully things will calm down. Then I'll come back. And unfortunately, a lot of people they actually don't want to go.
No,
so a lot of and this is what I'm seeing as a trend, because it's not the first. There have been changes to rules like this, but I think the raft of changes seem to have hit the sort of owner managed business and sort of the business community in a heavier load than other taxpayers. So it's become more pronounced.
Yeah, more and more people are talking about it. I know, as I say, in my circles, it's a common theme for sure. I was just thinking, if I look back on that, and again, we're not here to make sort of political statements, but I do remember the period when the new government came into power. There seemed to be a very long time before the budget, and so there was a lot of speculation. Looking back on it, I think there was a bit of a PR fluff there, because there should have been better communication. Because in the absence of real data and information, remember the budget was October,
yes,
and the election was July, I think. So there's many months. The press, the media, social media begin to make up stories, and there was a strong indication that capital gains tax might be aligned with income tax. And I've certainly been speaking to people who are planning to sell and think, hang on a minute, I was okay paying what was effectively 20% at the time, and now they want to potentially pay 45%. And then they begin to think about, it wasn't even on the agenda to think about relocating to another country. And they think, well, hang on a minute, I could actually pay zero if I relocate. And I know for sure a number of people who've literally done that or are in the process of doing that. So that's a bit of a challenge. As you say, it's kind of settled down. It wasn't as bad in terms of the tax hikes on capital gains, but people are still doing it. I think like the genie was out the bottle, if you like. Now the people are thinking, all right, hang on, I wasn't even remotely considering it, but maybe I should explore it.
Exactly. I think the pain points got so much that people who had never really considered it before started looking at it seriously. And when I mean seriously, people were going to those countries, looking at schools, other halves were getting involved. And I think once the family is psychologically pivoted to thinking, actually, we're not going to be here anymore, that makes it a little less, a little less friction to move out of the country. And that's what we've been seeing a lot of. And I think and I'm sure one of the questions is going to be, what territories are people going to?
That was literally my next question. You mentioned Dubai, but where else is kind of on the list?
I mean, Dubai, I think it is so specific to the client, so I won't comment as to where people should obviously go. But the sort of the jurisdictions that you would think about are the ones that people have been going to. So Dubai is probably one of the key ones that I've seen in my client base. Others have gone to Italy. a lot of the people in the finance community have gone to Italy. But I think what tends to happen is if your friends are going to certain places, then you think that that might be the place that you want to go to as well. So there's quite a big private equity community in Italy, and they, some funds have set up offices there, for example, and social clubs and things like that to make it amenable for people. So Italy's one, and then you've got Spain and Portugal, a little less so from what I'm seeing, but it's still a popular area. But Italy's one that's always been picked up on because of the sort of the regime of paying 200,000 euros.
So that's it. Just to be specific, you agree to pay a fixed amount of tax.
Yeah, it's a bit like what we used to have until April, where you had the non-dom regime, where you pay a flat fee, and then none of your income is taxable, especially outside of Italy.
What about Channel Islands, Jersey, Isle of Man? I've heard people talk about that. I'm not sure of what the benefits are.
Those are territories that people have always looked at. I've just not seen that as much in my client book,
right?
Because I think when people are looking, actually, for the first time that we're going to leave the UK, they want to look at somewhere sunny potentially, right? Or they at least romanticize the territory that they're going to because they've been on a holiday there, they've got a holiday home there, for example. But Isle of Man and Jersey and territories like that have always been
available,
very popular because it's so close to the UK, so you can fly back and forth. Obviously, there are limitations as to how much you can do that.
What are those limitations? Just say I've relocated to wherever. Are the ability to come back to the UK during is it territory dependent, or is it just you're
no?
Now, so wherever you are in the world?
Yeah. So the way to think about this is, so when you're leaving the UK, all we really care about is making sure that you're not resident here.
Yeah.
Okay. So as a tax advisor, that's what I'd be looking at to confirm the position. And then you've got to think about what territory you want to go to, and then there's the immigration process of that. So you'd have a different advisor who we can obviously link you up with to make sure you get the correct visas, and etc. But the rule of thumb, I would say, is you can go to a different territory and you can come back to the UK for, say, 90 days.
Every year?
Every year.
So you can spend best part of 3 months a year.
There are a few nuances to that, but I'm taking a very broad brush approach
to
say because it's to do with how many ties you have in the UK and things like that. Broadly, people have a couple of ties. That gives you 90 days. Okay. Right. And then that flexes up and down a little bit depending on whether you lose certain ties. So you could potentially every third year, you could get 120 days, for example.
Right.
But just to keep it simple.
Yeah, we'll call it
just say 90 days. Yeah, roughly 90 days.
But take advice if you're planning to do
that.
No,
100%. Yeah. Don't just go, I should have 90 days. That should be fine. But because it can go down to like 45 days.
So, right. Okay. So. Interesting. So just in a specific situation, and I've literally been speaking to a founder on exactly this. There is an exit going to happen maybe next year, and he's thinking, right, I'm going to get my ducks in a row, and I think, and he did look at Italy, and but he's landed on Dubai being the place. And again, this is, as you say, it's family dependent. It's not about how old your kids are and what the community, whether you've got aging parents and a bunch of other stuff to consider. But for this particular individual, it's ticking all the boxes for him. So that means effectively he goes and gets permanent residency in Dubai. He's no longer UK resident.
Yep.
And then he does the exit and he sells and he has this liquidity event. And that means there's zero capital gains tax
from a UK
anywhere.
Yeah.
What about in Dubai? Is there anything?
No, Dubai wouldn't pick it up either. So that's why it's quite popular to do that.
So people. I mean, we talk just ongoing day-to-day kind of income tax and everything else, but specifically around when someone knows there's an exit, we'll think, hang on, I'm either going to be paying 24%, subject to, of course, entrepreneurs relief and everything else, but broadly that sort of number, or zero.
Or zero, yeah.
Yeah. So that's.
But then you've got it's the friction of getting that tax value and having to live in a different country, which isn't home. Okay.
Oh, for sure. There's so many other things. And
so there's a psychological element there.
Yeah, definitely.
But yeah, from a pure tax perspective, it's feels like it's a no-brainer, right? Why would you pay tax here when you could pay zero tax somewhere else?
Everything else is stacking up and you're kind of mobile anyway, and your kids are of the age and all that.
And that's the point that we've been talking, other people have been talking about. The difference now to maybe 20, 30 years ago is people are very mobile.
Yeah.
They have options. They know they can find out about other territories. They can do their work on a laptop by the pool or wherever they want to be. And that's what
sounds quite appealing.
It does.
Yeah.
So I might be thinking about it. No.
Yeah.
Exactly. So I think that's why we've seen a massive uptick in either interest or actually people executing on their plans.
I mean, I never know how accurate the data is, but I've seen a lot of stuff published. It says, 10,000 millionaires have left. That was the number that's quoted a lot, but it does stack up in terms of your experience. People are doing it, and people are certainly talking about it right
Yeah,
now.
so it's difficult to say because obviously we're at the front, we're in the coalface of it.
Yeah.
So I don't know whether we're just seeing the small percentage that are thinking about it. Because,
Mm.
but from speaking to both the business community and entrepreneurs, everyone I speak to, they all know someone within their
for sure,
circle,
for sure.
which is very different from back in 2017 when there were
Yeah, it'd be
other
very
changes.
unusual.
Yeah, then people would be, not happy about what's happened, and they think, okay, that's I'm leaving. I'm going to Switzerland.
Yeah.
But there'll be a few of those. But here, it's anecdotally, someone in your circle who's done it, and that's different to before. So that just makes me feel, it might be in my own bubble, but that it's quite a common occurrence.
Yeah, but broadly speaking, if you trust the media and what have you, there is data now which says there's published information which seems to say it's not just you're obviously speaking to them as I am to some extent.
But playing devil's advocate, we don't know how many people are coming here.
Well, that's true.
So, but I think just anecdotally, for those of us who are working within this specific industry, we've seen a huge uptick in people leaving.
So it's interesting. Again, I think this is fact that numbers published recently since capital gains tax, in particularly, it was adjusted and the rates were moved up. The actual monetary amount of tax take has gone down. This is the famous Laffer curve.
Yeah.
Which is questioned by some people that whether it actually is true or exists or not. But to my mind, that's sort of playing out in real life. If the tax rate's gone up and the money they've received has gone down, I mean, what's your thoughts on that? Hi, just a quick pause. If you're getting value from this episode, I'd really appreciate it if you could hit subscribe and leave a rating or a review. It's honestly the best way to support the show, to help more people find it, and to make sure that future episodes get even better based on your feedback. Thanks for being here, and now back to the show.
Well, the Laffer curve is always an interesting one. It's always quoted. So just for context for those who don't know what it is. So the Laffer curve is essentially a curve that was, I think it was famously drawn out on a napkin.
Yeah.
Right.
By Mr. Laffer.
Arthur Laffer, I think.
Yeah.
I think it was in Congress, actually, just to explain tax take. The idea is that is the amount of tax revenue that the IRS, for that perspective, would receive if, say, tax rates were 0%, but obviously not receive anything, and if it was 100%, then people wouldn't be working, because what's the point working and giving away all your tax? So there's a sort of a blend and a rate within that curve that would give you the optimum tax take for a government. So here, I think to your point, you're saying, well, the rates have gone up, so therefore, you're not getting as much of a tax take. I think it's difficult to work through.
It's still quite early to
Yeah.
know the data, but the early numbers seem to be interesting. So.
It doesn't surprise me, because normally when capital gains tax rates are increased, they kind of let the taxpayer know that this is going to happen, and they introduce it in the new tax year.
Yeah.
And what tends to happen is people start accelerating disposals to take advantage of that. They didn't do that this time. They just brought it in on the midnight of the budget day, which means that you either you were in the process of being dragged into a disposal because you had to sell your business and you're in the process, or people have just stalled that and decided.
So people have put off
Yeah.
exits right now.
And I would say there's, from an M&A perspective, there's and I'm sure my M&A colleagues would be able to give a bit more data on that, but I think it's reduced significantly post budget day.
Yeah.
I think it's probably picking up a little bit now, but so that will probably feed into that.
Yeah.
But I know that people will probably try and tie this in with, well, people are leaving the UK and therefore, that you're not getting any capital gains tax.
Yeah.
As going back to the planning bill we were talking about. But I think it's difficult to.
It's a combination of all those
join
things.
the dots on that.
Yeah. And what in my experience tends to happen when rates are, I don't know anyone, honestly, entrepreneurs who are absolutely completely resistant to paying tax. Everyone's happy to pay. Everyone I've spoken to, happy to pay fair share. We know we get public services and happy to make a contribution. But if there's a sense that I'm now feeling taken advantage of, the rates have gone to such a level now that what begins to happen in my experience is people begin to plan. They do. Up until that point, they were saying, fine, I'll pay the tax, I'll write the check, it's perfectly reasonable. But there's more structuring, planning, more work for you guys, I guess, to us as well to some extent. But that's probably happening. There's lots more activity around this stuff, whereby there's a bit more benign in the past.
I think it's not one thing, as you say. It's different if, they just increased the capital gains tax rate. They've increased the capital gains tax rate. They've reduced the benefit of BADR.
Yeah.
They've, brought in inheritance tax changes. national insurance.
Yes.
Okay, employers' national insurance, that's a significant hit for businesses. So it just feels like everything, is stacking against
Yeah.
someone trying to grow their business. I mean, obviously, the arguments that people will put forward to say is, look, entrepreneurs, a BADR is reduced. That's going to disincentivize people setting up business. But most people, I would argue, don't go into setting up a business because they're thinking about
100%,
tax,
100%.
right?
They
You
don't.
being a founder, that's not
Yeah.
that's not the case.
It's not even on your agenda.
No, but these things are basically increasing friction.
Yeah.
Right. For you to maximize value in your businesses. And then at the same time, if you're successful, you kind of feel at the moment that it's not a good thing. That if you're making, if you've put in that blood, sweat and tears to maximize value, you've exited for a significant sum, people aren't going to be celebrating that you've done well.
No. Well,
it feels like, oh, well,
it's all right for you.
It's all right for you. And also, you should be paying more for doing that.
Yeah, no, it's a sentiment. It's a worry, really. It's a problem. Whether maybe us Brits have always been like that, but it just seems more noticeable.
I can't remember I can't remember where I heard this, but I feel like we always compare ourselves to the US, right? So the US celebrate success and the top 1% because I think they've got that real optimism that they can get to that level, so they celebrate that. And actually what they don't like is big government, and you're kind of seeing that playing out there. I think we've got a different background here in the UK in terms of, I think we have a class system, so therefore it's always, whenever things are tough, we kind of look at it from a class perspective,
so them and us type
rather than the governmental lens. So I think that's probably I think that's a wider thing.
Yeah, it is.
But it's interesting.
Yeah. I mean, talking of that, you're going through the list from inheritance tax, business asset disposal relief, capital gains tax, national insurance. I'm hearing people having, it's harder, R&D tax and tax credits and stuff.
Getting tricky to get into.
There's a lot of headwinds for people.
Exactly. And so we did at Blick Rothenberg, we did a roundtable recently, and one of the sort of views that were coming through with the entrepreneurs in the room was around, they're basically outsourcing people from outside the UK to other territories because of these headwinds.
Well, having employees or people to do work for them.
Yeah, consultants who are probably cheaper to employ.
Which is another thing of the sort of modern digital era. You can have employees or people who are doing work for you anywhere.
Exactly.
In a more cost-effective way. So again, that's therefore a challenge to, regular employees trying to get work. And I'm hearing the job market is getting tougher. Graduates trying to get into certain work. Again, anecdotally, it's not as easy perhaps as it has been in the past because those amongst many other things, employers are probably tightening up, freezing new hires. Not necessarily. And the backdrop again, there's a whole other conversation is AI and what that's can do now for for a lot of roles. So there's quite a few challenges for both employers, founders, but also people who want to work for these companies as well. And just briefly, I know a couple of fintech founders, fantastic young guys, and they were trying to raise money and they were trying to do a lot of things here. And the British London based. Where have they gone? They've gone to the US. Yeah. And I've been speaking to them and said, it's just different. He said, people are throwing money at you. There's
more money there,
There's more money there. Yeah. It's like an aspirational culture. People are really trying to kind of help each other out. And he said, they're obviously in Silicon Valley around there. And he said, all the people that you meet are just thriving and just most of them trying to do really productive, good things for the world. And he just said, it's just, you didn't get the sentiment in the UK. So it's a worry. I mean, hopefully things will evolve and things will change. But one thing that I'd never heard of before until quite recently, again, I think this is in your area, Delaware Flip.
Yeah, it sounds really cool, doesn't it?
It does.
Sounds like a TikTok trend. I wish it was.
Tell us about that.
I'll give my sort of headline on this because this is a US point, but essentially what this is when you have UK founders who are trying to raise investment. What a lot of investors, especially the US investors, prefer is a US vehicle. So a Delaware flip is essentially having a US Delaware-based US Inc. Sitting on top of your UK company and doing a share-for-share exchange, typically to insert that holding company to allow investors to come in.
Investors invest in the holding company,
correct,
which is a Delaware registered company.
Correct.
And how does that impact the day to day for running? But underneath that, is it, I don't know, a UK limited company?
Yeah. So I don't want to give any advice
No,
on
of
this,
course.
but there are a lot of considerations to make on that. Okay. So I think the broadest one, the rule that I've understood from this is once you've got a US holding company like this, it's very difficult to reverse it.
Okay.
So if there's a way that you could simplify the process by virtue of having a subsidiary of the UK company and allow people to come in through that, then that's more helpful from a tax perspective.
Okay.
Because I think
But
unraveling it can cause crystallize a lot of taxes.
okay. But is that one of the primary advantages is raising money from US investors?
Yeah. From what I've seen,
Right. Okay.
That's
I mean, has this been around forever? So I guess you could have always registered a company in Delaware, I presume.
yeah. Delaware is a very popular location.
Sure, it's got tax benefits and various other things.
So I mean, I won't delve into all of that, but
yeah, sure.
But essentially, that's.
But as I say, I've never heard of it before, and now I'm seeing a lot of people just talking about it. So obviously, it's a thing that people could, in certain circumstances, would consider.
They would if they want to go to the US, and if they're thinking about, as you said, for your fintech.
Yeah.
Chaps who, if they want to IPO there, for example, then they might need to have a Delaware registered holding company. So I think you've got to balance everything to make sure that it works for you.
Yeah, makes sense. Yeah, lots going on, isn't there? What I want to talk about now, really, is we've talked about people kind of getting their house in order pre-exit, pre-liquidity, and all the various things. There's quite a lot to do, and time is of the essence. Get started, have the conversations now way ahead of time. Talk me through the situation. So imagine somebody has exited. And of course, obviously, every circumstance is different, but someone has, a founder or a team of founders has come out of a company. They've had a successful sale of the business. They've now sort of swapped the shares in the company for liquidity, cash, effectively. The circumstances are now different. What are the key tax considerations for a post-exited entrepreneur sitting on substantial cash? A quick pause. You might not be aware that this podcast is a passion project. It's born from my commitment to supporting entrepreneurs through the business stages of scaling up, selling, and then life on the other side. It's the same work we do at Capital Partners, our boutique wealth planning firm, which is dedicated to helping entrepreneurs to gain clarity around their money, their aspirations, and ultimately achieving financial peace of mind. With over 20 years' experience of working with business owners, our team brings deep insight, strategic thinking, and clarity to what can often be complex decisions. So what you're really looking for is a trusted advisor, someone who understands people like you and can offer thoughtful guidance at the intersection of business, family, money, and life. In other words, someone to act as your strategic thinking partner and your financial coach. So if that resonates, feel free to explore more. There's a link in the show notes to our website with tools and resources to support you on your journey. Now, let's get back to the conversation.
Okay, so I'd always bring it back to objectives, right? Okay, so now that you've got all this cash, what are you going to do with it? What do you want to do with it? So the conversations we typically have is alongside like wealth advisors like yourself to say, how much do you want to keep personally for personal consumption? Like if you want to buy a new house, you want it for school fees, you want it, for, just fun money, versus what do you want to potentially reinvest, etc. So that reinvestment piece is the bit that we can help structure. And how should that be done? And one of the things that you probably come across quite a lot of is family investment companies.
Yeah, exactly. I wanted to talk about that.
It's very popular right now. And people like it because trusts are kind of falling out of favor a little bit because of the complexity of it and a lot of the way that the rules have, the benefits of the rules have slowly eroded away. I mean, there are still benefits there, by the way, just in case, just in case people start jumping up and down and saying, oh, actually, trusts are still really helpful. They are as legacy vehicles and for inheritance tax purposes, it can be helpful. But what I'm seeing right now is those who want to manage their funds in a more tax efficient way and think about succession to the next generation. Family investment companies are very popular, and the reason why is because people understand companies. And that's essentially what it is. It's a company where you have like a couple of one shareholding for generation one, so for the founder and maybe their other half, and another shareholding for say the children. And the reason why they like family investment companies as well is that you can enhance your wealth or wealth maximization in a low tax environment. So rather than, let's say, you're receiving interest from an investment,
Yeah.
you're going to be taxable at, say, 45%
Sure,
on that.
yeah.
Whereas in a family investment company, it would be taxed at 25%.
Okay.
Another thing is if you're investing into, you become a sort of an angel investor and you take a 10% shareholding in a company, a trading company, you could potentially, within certain relief, if you get some certain reliefs, when you exit that after 12 months, that could be tax-free within the company.
So your angel investment, you say,
Yeah.
when you
So
come,
you
you come
take
out
a
of that, you have it within the family investment company vehicle.
Yeah. Whereas if you did that personally, you'd be probably subject to capital gains tax at 24%. So.
Yeah. Okay, so they are becoming more and more popular, particularly. I mean, they apply to anyone in theory.
I'd say due to the complexity. I mean, there's, you're going to have legal work done on it.
Yeah.
You're going to have a tax advisor talk to you about it and advise you on it. You'll have to. You've got more accounting and corporate tax like compliance to do.
Well, you're right. It's a company. That's the point. So,
So
a whole lot of ongoing
Yeah.
administration and
But so I would
reporting.
suggest that if for those people who are listening to this, if they've got 5 million or so, I think
that's the kind of entry
that's
level
where
it begins to make sense then.
Yeah.
And when you reflect the costs.
And sorry, 5 million, that's in excess of what you need personally.
Yes, yeah. Other than your fund money and your
Yeah.
new house and new car and everything else. It's
And-
kind of
and-
long-term
Yeah,
investment.
but it is flexible because typically people sort of go into these vehicles by lending that money into the company.
Okay.
So if needs, if they get pushed to the wall and they need to take money out, they can tax-free because they take that loan back. But I wouldn't suggest that's the reason why you do it. You're trying to do it to try and enhance the wealth that you're creating.
Sure. And how does inheritance tax work within family investment companies?
So the way I sort of position this with clients is what you're essentially doing is you're freezing your exposure to inheritance tax. So let's take an example of you put in this 5 million as a loan into your company. That 5 million asset is still within your estate because you've got a loan to a company and that's still subject to inheritance tax. Okay, ignoring nil rate bands of
all the other allowances,
all the allowances and things like that. What you're doing is the future growth can be given to the next generation, and so that becomes their inheritance tax issue rather than yours. So anything, say you would normally do that at a hurdle. So say you brought them in at say 6 million. So anything with 6 million and above goes to them. Then you've basically fixed your estate issue.
Yes. So your own personal inheritance tax liability is kind of is capped, frozen. Then future growth that's already owned by
the kids,
next generation.
And then obviously you can layer on. I mean, I did say about not to use trusts or not. I didn't say that exactly, but I said trusts are not. But you can add a trust to own the shareholding that the kids would be a beneficiary of, right?
Right.
And the reason for that is it depends on what your kids are like, what age they're at.
Sure.
You've
got a load of other considerations.
Yeah,
there,
so you could at least have a vehicle that controls what access they have.
Okay, so again, there's complexity for sure, but there are benefits. Your firm does quite a few of these family investment companies.
Yeah, so we look after. Yeah, you're absolutely right. So I think one of the things that I'd like to say that we're very market leading in doing is we obviously advise on it, but we also look after them. So we will not the wealth side, obviously, and people like yourself would do that. But,
Thank you. Yeah.
But we would do the accounting and the
just the ongoing reporting and everything that's required.
Reporting, yeah. And we look after about over 90 of those.
Okay.
At all levels, to all the way from say 5 million to 9 figures.
Okay.
Sorry, yeah,
9, yeah.
That's
a lot of zeros.
I was just double checking I wasn't.
Yeah. Interesting. What about just thinking back in the years you've been in this and tax advice? Any kind of good stories, bad stories? But what are some experiences? Obviously, retaining client confidentiality, etc. But stories about people who've made some smart moves, and or people that might have made some less than smart moves and wish they'd maybe spoken to you ahead of time.
I think, without reiterating what I've already said. So I think those people who've taken advice early, they've come out of it in a very controlled manner and with probably the most, like, the optimum tax position for them. especially those who are thinking about leaving the country. So that's probably the nuclear option, and that's probably just purely from a tax lens. I'm not talking about the appropriateness of the tax legislation, etc. But leaving the UK and timing it correctly, you've got a very good result from that.
Mm-hmm.
Or if you realize that this is a second or third exit, you don't really need this money for yourself personally, then having a holding company that receives those funds could essentially be tax free within the company level. Obviously, if you take it out, it'll be subject to tax. But for reinvestment purposes, that's a really good position to be in, especially if you want to reinvest into other things. So that's the sort of the gambit of where it works really nicely.
Yeah.
I think where it doesn't work is where an email comes in, we're going to be selling in 2 months. Yeah. Can you help us restructure our shareholding? Can you look at what we need to do? We're kind of, it becomes an A&E situation, because you just essentially, the buyers come in, whatever skeletons get uncovered, we'll help deal with that. Sure. But you're not in control of the process.
Right, and I'm sure you've looked at situations and say, "Wow, if you'd spoken to me even a year before, especially 2 years ago, we could have really helped you."
Yeah, so that holding company one, I had someone who unfortunately their previous advisor hadn't even thought about that for them, and they were exiting for a significant sum, which look, it's still a good, it's a good net position,
sure,
but it's not. It was not optimized at all, and it was unfortunate that they lost out by They lost 10% basically on the gross proceeds,
and we're no doubt talking in the millions here as well. So
exactly,
I think all roads lead back to get advice. Build a team of professionals. Build if it's a pre-exit team or whatever. Build that community of people that are helping you, advising you, and guiding you way ahead of time. By the way, a lot of these things I find, on a human or a personal basis, it takes a little time to process. You say, well, you can do this, you can do that, whether it's relocate overseas or set up a family investment company. It's not something that you just make a snap decision.
You don't make a snap decision, and also you need to go on that journey to educate yourself to understand what does it mean. Like, I know this advisor's telling me this, but what does it actually mean? And does it work for me?
And none of these things are a silver bullet. You must do this, and this works every time. There's trade-offs, there's compromises, there's for and against. So, and as I say, if you've got months and you sort of reflect on it, you educate yourself, you learn a bit more the positives and the potential downsides, and then you come to a sort of a nice decision, having weighed everything up. Then you go through, then it kind of, hopefully the exit goes through fine. And I think it's a nice thing to know, look, we left no stone unturned. We could have done a few other things, but we chose not to because, for whatever reason, but we explored pretty much everything that was available. And of course, the other thing is, stuff's changing all the time as well, keeping people like you in gainful employment.
Well, it's as you said, I want clients to make an informed decision.
Yeah.
Whether you decide to do something or not decide to do something, but at least you've reviewed it, looked at the pros and cons, as you said, Alan, and then you decided to go for it or not go for it. Whereas when you're in the middle of a transaction, you don't have the headspace for it, to be honest.
For sure.
So you're not going to have time to think about, okay, when I receive my funds, this is how I'm going to receive it, and you're running
you just
around.
Don't. You are just head down, just trying to get this.
Adrenaline levels high. You've got people asking you loads of questions. You don't have time for that.
Yeah,
typically
so do it when you're in the sort of just as you say, business owners are busy enough anyway. There's always things kind of coming at them, but create that mental headspace, I think, and the time to reflect, understand, so that you're going into a transaction really clear about what you're doing, and so it's not taking up any sort of brain space. You just go ahead and going through that as you say, that's sort of the actual transaction. And I've known people, and I've certainly had guests on the podcast, and it goes on for months and months, and it's just mentally draining. You don't need another thing about tax structuring in addition to that at the same time, ideally.
And also the other thing that we try and do is introduce them to a wealth advisor, actually.
Right. There you go.
Yeah, there we go. So bring him with you.
Yeah.
Because it's another thing, because it's so interesting to see, because they get a lot of entrepreneurs get so drained from the transaction process that once they've converted something they've grown and loved, which is their business, which they then maybe participating through earnouts, but it's kind of they're not in control anymore, and they've sort of substituted that for cold hard cash in a bank account. They kind of lose interest. And then they're just like, I just want to get rid of this thing. Like, I'll just give it to, if it's X amount, I'll just divvy it up to 2 or 3 pots and give it to people without, not everybody obviously, but without the process of thinking about, okay, why am I allocating it to this advisor, or why am I allocating it to
Sure.
this bank? So that's where,
I'm a complete an advocate for all that. The idea of having like a trusted advisor in your camp, somebody that what has your best intentions as an exiting entrepreneur, but that you trust and that you've been on the journey with as well. I think that's really important. And the other thing I always say post exit is, it's been such a stressful period. Just have some downtime. Like, don't do anything.
So true.
Because I've seen it, unfortunately. You talk about people coming to you maybe sometimes a bit too late, and I've had it as well. They've already exited, and we said, well, you could have done a few other things. But also, I always say to everyone, you even post exit, you're still in a heightened state of emotion. You've got a new way of being, a new way of thinking now. You're no longer this business owner. So don't make any rash decisions then.
Yeah.
And unfortunately, as we know, they become a bit of a target for other people trying to sell them stuff, whether it's fancy cars or investment funds or whatever. So best is to do nothing, because you've done all the work way in advance.
Well, the other thing is, as you say, that because they've pivoted from being super busy, their calendar's packed, to maybe not having anything.
Yes, literally nothing to do.
Which is very odd.
Yeah.
The natural instinct could be just to dive back into a brand new business or set something up new. Which, I think that's a whole different podcast to work through what the sort of psychological journey of coming up to a sale and selling.
No, for sure. And I've had numerous guests on in the past, and certainly people. A guy's written a book about this. He interviewed 70 in the States, 70 exited entrepreneurs, and there's things that people have done quite successfully and people have done less successfully. But jumping back in, starting a new business, even being a sort of coach, consultant, all the kind of list of things that people do, not necessarily do they always work out. So that's yet another thing to be thinking about, is that literally just life post-exit. And it depends on your circumstances, your family situation. But actually, I just think it's imperative, because the challenge is everyone's so busy. Just, you owe it to yourself, even at a weekend or something, go for a nice long walk and begin to imagine life afterwards. And all roads lead back to build a team around you, people that you like and people that you trust. And, we can all kind of get through that journey together. I think it makes a lot of sense. I've got one last question for you, if you don't mind.
Yeah.
A question I ask everyone. You've had clearly a sort of rich and interesting, personal backstory. You work with money and tax. You help out quite a lot of successful people. And I'm always intrigued by this concept of wealth and what I call the definition of true wealth. And you can say money, but what's your personal definition of true wealth?
It's such a good question. Such a good question. I think it's in various arenas. Okay. So I think, as you rightly said, true wealth kind of, people naturally go to a money number or a figure and financial freedom, and they focus on that. But I think you can't really have that unless you've got health.
Right.
So I look at, as a true wealth is having a healthy lifestyle, because I've only got one of these, and this is the means to do everything. And also having a wealth of friends and family, So I think, for me, as having young children, I think my focus has been just to make sure that they're happy and I give them enough time. So for me, wealth encompasses a sort of three buckets. Money is important, but I wouldn't say it's the number one priority. As long as you've got enough to feed yourself and you've got a home, a roof over your shoulder, over your head, it's the health and the family and friends piece. And I think I personally are trying to focus as much as I can on sort of the family and friends piece, because I think typically people are focusing on the career stroke, and the sort of financial position. And I mean, over the last 12 months, I've been focusing on the health and the family piece.
Well, particularly with your background, it makes a lot of sense. Particularly on
I know,
but
the health side. Doctors are the worst. They don't take their own advice.
I have heard that. No, I think you're spot on, and I think you make a very good point there, particularly on your family is super important, but the health as well. Yeah. And as an entrepreneur told me years ago, he said, as they say, when you get on an airplane, they always say you put your own oxygen mask on first. You got to look after yourself. If you are not in good shape or unhealthy, it's like the domino effect. Everything else, family suffers, business suffers, everything else. So you do need to focus on that.
Completely agree with that. And I think it's also sort of physical health, but also mental health as well.
Sure.
So just, building up that resilience and especially when you've got children, you just want to make sure you don't pass on those issues to them.
Sure.
So that's...
Yeah, but sure, that's a challenge. And I've gone through it, still go through it. kids and you want to spend time with kids and young family, but you got business stuff to go on.
Yeah.
And you've got it's just life, isn't it? Just juggling so many things. But I think it is important, as you rightly say, you do need to put yourself first on that occasion. And entrepreneurs often don't. They put themselves last sometimes. It's all about the business, really. So look, thanks so much. I really, really appreciated the time. It's been like a tax masterclass. I hope people just pick. Obviously, we're just skimming the surface. There's so much we could go into, and maybe we'll have another conversation and take a deeper dive in one or two of these specific subjects. That'd be great. So really, really appreciate your time. If anyone does want to learn a bit more about you and reach out to you, what's the best way? Is it your website, or what's the best way to get in touch?
Yeah, I mean, there's the Blick Rothenberg website, but I've got a very uncommon name. So if you Google Malli Kini, you'll come straight to the Blick.
They'll find you. Site. And you did say, if you're still good with that, if someone does want to reach out and just do a 15-minute
happy to do that.
Chat about their own circumstances and just give them a bit of pointer and guidance. That's brilliant. Again.
Unless there's some sort of a code or something that you want to give.
No, at all. They just get in touch with you.
Yeah.
And I hope people do. I hope people get in touch with you, because clearly you've got a lot of expertise and knowledge, and specifically around this kind of the whole thing. And frankly, this podcast is all about just creating some resource for entrepreneurs. It's tough. It's tough out there. There's a lot of stuff coming at us now more than ever. And just to have some resilience through some knowledge, some information, and some guidance, I just think it's really valuable. So I really appreciate what you're offering to the community.
No, thank you for having me on, and I think it's fantastic what you're doing.
It's great. Thanks so much.
All right, cheers.